Today, I'll share 6 investment mistakes in the stock market that cost me at least $1 million in future wealth. I realized these errors after spending thousands on sessions with investments mentors, and I'm sharing them with you for free. Let's dive into the mistakes. First, having a short time horizon. I used to wake up in the morning, buy a lot of stock at 9 a.m. and sell it at 2 p.m. All the time, stock market breaking news and social media like TikTok, Instagram, and YouTube financial advisors were feeding me, and I just bought the stocks blindly. I was following the madness of the crowd. If Apple stock is liked and shared by many beautiful girls on social media, I would end up buying it. Humans are like monkeys who mimic what other monkeys do. If your friends say, "Your girlfriend is amazing," then in your subconscious mind, you will surely like her more now as you got social endorsement. If a festival gets a hit and your friends recommend you go to the festival, surely you will plan. So all the time, I was following the herd but was never truly investing. All I did was speculative trading. Ben Graham, the author of the Intelligent Investor book, said that in speculative trading, the stock market will instruct you while it should have been serving at first point. It is important to understand the difference between serving and instructing. For example, when you go for dinner with your stunning girlfriend at a restaurant and the owner of the restaurant dictates you to eat a lot of food you don't like, they are instructing you, but if you get a dinner menu or order a couple of items, voila, the restaurant is serving you. The same thing happens in the stock market. Every morning, financial clones pop up on your phone shouting, "This stock is steel and it's about to double in 2 days." If you rush to buy it, fearing you'll miss out on a jackpot, well, congratulations, you have just been instructed by the clone brigade. But conducting thorough financial research and choosing wisely from numerous stock pitches in the market serving you. Coming back to my dumbness, I was never a value investor. A value investor takes a long-term view of the company, reads the financial statements and industry, picks 4 or 5 business stocks, and then keeps that stock through thick and thin for many years as he believes in the true fundamentals of the business. That's why value investors like Seth Klarman, Monish Pabrai, and Warren Buffett are so rich because they don't follow social media and finance clones, while I was doing the complete opposite. I was buying it for 4 or 5 hours, and on average, I lost money every year because stock market mood swings and social media feeds were there to shorten my time horizon, and I was in a trap called the quick rich scheme. So the lesson is, never let these external forces shorten your time horizon and always think long term. Second, using debt to buy stocks. Charlie Munger has a famous saying, "A smart person can go broke only 3 ways: lady, liquor, and leverage." You might be laughing, but it's true. I already had a beautiful girlfriend, which meant I was 1/3 broke. And then I took $100,000 debt from a friend to invest in the quick get-rich stock. But the stock plummeted and ultimately the company went bankrupt. Hence, I lost all my money. And guess what? My girlfriend also ran away once she saw me in financially broken circumstances. I'm living proof of Charlie Munger's saying. Now I'm making YouTube videos to earn money to pay back my debt. But I will surely be careful of gold digger girlfriends in the future. Now I use debt to buy a stock whose underlying business you cannot understand, or you will lose a girlfriend. This brings me to the third mistake, not building a circle of competence. I used to consider myself an overconfident Iron Man of the stock market who know everything about every company and industry. The mistake was not building a circle of competence. Always build your circle of competence about businesses and stay within it. It does not matter how big or small that circle is. What matters is what are the edges of the circles. For example, I cannot understand pharmaceutical stocks, but to some extent, I can understand the manufacturing industry as I practically got my hands dirty while working in a chemical plant for 6 years. Never invest beyond the boundaries of the circle. And don't be jealous if your circle of confidence is different from mine, as you already have something what I don't have. You cannot have everything in this life. Now the question comes, how should we enlarge the circle? There are two means. 1. Reads books and the financial statements of the companies that are beyond your circle. For example, if your circle of competence is in the software industry, then slowly try to read about the automotive industry, and in some time your mental model will develop there as well. Second, read the letters and articles left by old investment specialists like Warren Buffett, Charlie Munger, and many more. Specifically focus on what mistakes they made. You do not need to reinvent the wheel, just don't repeat these mistakes and I'm sure you will get rich soon. Fourth, buying cheap stocks. I used to buy a stock that is trading at a 20% discount as compared to the past 5 years history price. I bought it based on the mathematical reasons instead of on fundamental business research. And guess what? These stocks deserve to be cheap. Why? Because either the management changed or the new competitor came in and disrupted the whole industry, or the revenue or the cost models were not working. In short, there was some reasons for the stock to sell cheaply, but I was ignorant. The stock fell, I bought, but it never recovered. So never buy a stock based on mathematical trends and charts. If something is trading cheaply, it most probably deserves to trade cheaply. Always do research when you see a stock selling cheap next time. This brings me to the fifth mistake, not doing research. A lot of times it happens that a friend gave me a stock tip and I bought it in my portfolio, but after 6 months, his investment thesis got changed and he sold it, but unfortunately, I kept on holding that risky stock as I got disconnected from that friend. I ruined myself by believing in others and proved myself a fool. So, always do your research. When I tell people to do their research, they get frustrated, and I reply to them with a Charlie Munger's quote, "Why should it be easy to get rich? Why would it be easy for you to buy a diamond ring for your girlfriend?" The best benefit of your research is that people would not be able to sell you a foolish idea. Sixth mistake, falling in love with stocks. It's okay you fell in love with a girlfriend, but never with a stock. Imagine you understand a good business and bought the stock. Your action to buy means you are making a very arrogant statement that you know more about company than the huge crowd of people. This arrogancy blinds you, as you will have a confirmation bias. Human brains are so beautiful that we love to interpret to keep our older conclusions intact, when ideally what we should be doing is the exact opposite. Imagine after 6 months of investing, new information came, but your mental blindness did not let you see the new risk, but instead of further solidified the already existing belief and you kept the stock in your portfolio instead of selling it. I must admit, this arrogant blindness cost me a lot of money at least. Always avoid this orgasmic love affair with stock. Buying a stock is sometimes easy as an investment idea clicked with you out of nowhere. But selling a stock is not easy because by the time the stock should have been sold, you got emotionally attached to the stock. To cure this blindness, always have someone to discuss and counter your ideas. Now, you should go tell your girlfriend that you learned things about stock market investing from a handsome guy. In conclusion, these mistakes have taught me valuable lessons. Feel free to share your own experiences in the comments and suggest topics for more investing discussions.